Hey guys, so in this video I just want to try revisiting and rebuilding my stock prediction models to hopefully gain some better results than the last times. My model will be trading on the S&P 500 using past daily data from 2007 to 2019. The main difference in this approach this time is I'm also using options or futures data from the CBOE in addition to volatility, macroeconomic, and technical indicators. So I started out with a sklearn pipeline consisting of random forest regressor, but then I switched to extreme gradient boosting for better performance and speed. I recommend XGBoost for virtually any regression and classification tasks. So first of all, you'll need to install and import these important Python libraries: pandas for data frame manipulation, NumPy for some of the math and indexing stuff, matplotlib to graph and visualize everything, pandas TA for technical indicators, and sklearn for model preprocessing and building the pipeline, as well as assessing how good the model really is. We also need XGBoost for the model itself, and I'll show this later, but we'll use backtesting.py library to backtest and see how well the model really performs in the market. Then I define a function to load the CSV file, which has the options to skip the first few rows and set the first column as the date index. I also made the date cutoff function, which is self-explanatory. So we'll be feeding the model the closing price of the last day and its difference, and the percentage change compared to today. The targets of tomorrow's change compared to today's close will be what we're trying to predict. Next, I loaded the Chicago Board Options Exchange, the total exchange volume and put call ratios from 2006 to 2019, that's the date period for all of these options data, the index volume and put call ratios, equity volume and PC ratio, exchange traded product or ETP's volume and PC ratio, volatility index or VIX volume and put call ratios. And then the economic and volatility data will be inflation rates, which I assume is the percentage change in consumer price index, and expected inflation for 5 years, as well as interest rates and VIX market volatility index. Now it's time to make the technical indicator columns. Now I'm not saying whether technical analysis works or doesn't work, but I'm just taking my chances. So we'll have relative strength index, which supposedly is above 70 when it is overbought and below 30 when the stock is oversold. And moving averages convergence divergence to measure price momentum and potential buy or sell opportunities. Average true range measures volatility and will also be used to calculate the strategy's stop loss later as we backtest. Stochastic oscillator is used to identify overbought and oversold conditions. Volume weighted average price finds the average price of a security based on both price and volume. It can be used to confirm momentum or trends and any potential exit or enter positions. Bollinger Bands is another indicator that can identify overbought sold or overbought and market volatility. The fast and slow moving averages are used to find the average price over a specified period. Donchian indicators can find breakout and potential trends. So after concatenating all of these into a single data frame, I also added percentage change, mean, and difference of these columns. So in total, we have 36 technical indicators out of 72 columns and 3,200 rows in the fully merged multi-index data table. So after all this is done, we need to define the labels and features, or the things we're trying to predict, and the data will be feeding the model. So make sure you're not leaking future data, and this is really important. So this is the main pipeline, which consists of a simple imputer which will basically suppress any errors or unknown case the model has, and then we also have the XGB regressor model itself. Then we split the training and testing data to assess the model's accuracy. The model's R2 can range anywhere from 0 to 1, and our score is 0.69, which is pretty decent for stocks because it's chaotic data and unpredictable. We can also see which features contribute the most to the model success and exclude the unnecessary ones to cut out or remove the noise and boost its accuracy. In this plot, you can see how the model's predictions turn out against the actual targets. The straight red line in the middle is a perfect prediction. As you can see, it follows pretty closely. And these two graphs compare the model predicted returns versus the actual returns for each day and the residuals, or the difference between the predicted and the actual. Now it's time to actually backtest this model against the market with the backtesting Pi library. I just basically feed the predictions and buy whatever the model thinks tomorrow's returns are above a threshold, and sell whenever it predicts the opposite. The stop loss is a function of the ATR. The take profit is the stop loss times a set multiplier. The size of each position we enter depends on how confident the model is. So we start out with $10,000. As you can see, the strategy performs okay in the beginning, but it levels off and underperforms in the long run. The total return is about 4 to 6% compared to the superior buying and holding. The compound annual growth rate and Sharpe ratios both indicate this is a bad strategy and that maybe I should dedicate my time to more interesting projects. We do have an average win rate of 43%, which is better than 16 or 20% last time. This result is pretty consistent with efficient market hypothesis, saying that there is basically no consistently exploitable advantages in the market. Does this mean buying and holding is still the superior strategy for stocks? Let me know what you guys think. Thank you guys for watching. I'll see you in the next video.